Okay. This video is inspired by me watching another video in another channel talking about the RobinHood account, margin account, and gold option. And watching that just scared me to death. It's from a channel where they advocate, everybody should be day trading. And what really bothered me about it is it really didn't point out the fact that if you're day trading using heavy margin, you could be broke the same day. I mean, because if you get a margin call, you've got to transfer the funds immediately, or they're going to liquidate your position at whatever the market is, which could be just terrible if the market's making a strong move one way or the other, which in this current market, as volatile as it is, that could be anytime. And if you're in one of the tech stocks or one of the meme stocks, it could wipe you out. Now, I have a margin account, not for day trading. It's something I don't want to actually use, except that the option account gives me instant settlement of options that are exercised or expire. If I had a cash account, there would be a 3-day settlement period on the options that are exercised. So on that portion of my portfolio, I'd have to wait 3 days before I could use it to cover options again, which, since I'm doing a 5-day option, that's totally unsatisfactory. So for me, it's necessary. I'm going to jump over to my account screen here. All right. I guess start from the beginning is the best way to do it. All right, I've got a total portfolio value of $14,863.79. But that's not actually what's in my account. I have $15,958.79 in cash. Well, where did the minus $1,095 come? Where did that come from? How did they calculate that? Well, that's the amount I would lose, or need, I guess would be a better way of putting it, need to close out all my positions by buying back those contracts, which I don't do. I always let them run to expiration, which means that number goes away. All right. So at settlement, depending on what my put strikes were, my call strikes were, this will certainly change. Now, as it turns out, this number here is a running number based on positions marked to market. So typically the way that would end up is exactly as it says up here, $14,863.79 after settlement. Okay. Now, down in the margin, which is what we're talking about, I've used none. So I've got no interest being accrued. Under margin maintenance, it shows $14,505. Well, that's the amount of cash that I'm using to cover all the put contracts I sold. And then it shows a day trade limit, which I ignore because I don't do day trading. Okay. Now, the video I watched, the fellow had already had, if you look down in this area here, the day trade these circles. Day trading or pattern trading, as it's more properly called, that's placing a sell and buy order on the stock. You're buying a stock and selling it the same day. And so he already had 4 of these, or 3 of these used. And this is in a week period. If he had one more, then that was going to lock him out of his day trade. Although in the settings page, you could turn that off, which means you're running wild, man. Well, yeah, that's high roller tables. I, on the other hand, just look for steady income and to minimize my risk, which I've done successfully since 2005. Okay, have I covered it all? The gold status. The gold fee, which I'm being charged $5 a month, and I can deposit up to $10,000 instantly, have it instantly trade on that. Like here, I have a deposited Wednesday, or I think Wednesday, $2,000, and immediately sold 3 additional put contracts. And so I used $1,641.21 of that. But I was able to do that instantly. And for that, I pay a $5 fee. That's handy, but not, the gold status is not absolutely necessary. You just have to judge your own needs on how likely you are to want to put in cash you got laid on the side that covers some kind of opportunity. I use this mostly for arbitrage. And that's a whole another subject. But arbitrage basically means that you're using one market, you're using 2 markets, stock exchange and options exchange in this case, and a momentary disparity in those prices. And those kind of things happen very quickly. They come and they go very quickly. But so if you want to take advantage of an arbitrage situation and you don't have cash in your account to do it, then the instant deposit works out well. I've used it maybe a dozen times in the last 5 years. So I don't know whether I'm getting my money's worth out of it or not, but I did use it Wednesday, so yes, I am. Because for that, I received a premium of $105, so that will pay for 30 months fee on that. So I guess it is worth it. All right. Well, I hope I haven't confused you more than I've helped you. But day trading is well, it's like a little bit like you know what a game of chicken is? You know, when 2 people get in their cars and they come running at each other and see who's going to chicken out and turn first. So to me, day trading is playing chicken. That ranks right up there with doing bear options. Bear options where you don't have the collateral to cover the option. And typically those are not offered to you unless you have an account with a cash value of about $250,000. And those people can get in trouble. I mean, because on bear options, it's like selling short. Your risks are infinite. Now you're not going to have an infinite risk all the time, because when you have one of those, you're pretty well broke. But I'm not in the, I'm not, even if I were a young man and had time to make up for being totally bust, it goes against my grain to do so. I'm really not a gambler. I want to look at the odds and know I have a good chance. And of course, selling covered options gives you an income stream. So even if the market goes badly against me, at least that's mitigated by the amount of premiums I've collected. So anyway, I'm overdoing this subject, I guess. I apologize for that, but you really need to understand the dangers of using margin for day trading. It's just, or even for covering excess put contracts. We've had a combination of put and calls, and the closing price on Friday, which determines whether they're going to be exercised or not. I could have written contracts to the point where I ended up with too many shares for the cash I had on hand. So I couldn't pay for them all. Well, the difference will be made up out of my margin. And that's okay if it's not using it much. If I ever get even near 50% of my available margin, I get nervous about it. And at 50%, that allows a pretty big shift in prices before that would put you in danger of a margin call. But still, I just don't like to use margin. And as the interest rates go up, generally the interest on the margin used goes up. Now, true, those usually only last. I usually have that covered by other contracts being exercised within by 5 days. So those balances don't remain long, but still, be careful of that, because you see that available amount, buying power. Before you use that buying power, be sure that it's not going to put you into the use of margin. I'll try to do some examples of that ongoing in some of my routine trading things where you can see examples of that. But this is just a warning reel, Will Robinson, to quote the old Lost in Space series from the 60s. If you have questions, put them down in the comments. I'll do my best to answer them, because this is an area of your account that will prompt questions and legitimate questions. And I'll do my best to answer them. And your questions may when I answer those, it may be answering questions other people had and just didn't put them in the question in the comments. All right. Well, good night. And tomorrow is Friday, so that's when all my options either are exercised or expire. They all end on Friday after the close of trading, and on Saturday they settle. Meaning that everything is reset and unencumbered, so I can use my cash to cover puts and my stock to cover calls. And then Monday is payday. All right. Please subscribe. I appreciate it. There's a link to my newsletter down in the description, along with some other interesting and helpful links.